Hey everyone, thank you for attending the Place Your Trade Network Spaces to discuss currencies and yields. This Spaces is brought to you by TraderMate, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. You can now trade these on the DOM on TraderMate's main platform as well. They're a great way to get exposure to the futures markets with limited risk. You can use the link in my Twitter stream to go get the TraderMate app for free. I also write a weekly blog and daily pre-market overview on markets that you can subscribe to at placeyourtrades.com. It's absolutely free. Just need to sign up. And then I'll be doing a summary of this episode with my key takeaways that'll be available as a download PDF. So if you're interested in getting this PDF, please click the link in my feed. I'll also put it up in the nest or visit placeyourtrades.com/spaces to sign up for it. And the PDF overview will be available and emailed out to anybody that signs up. And now on to our guests. Our first guest is Blake Morrow. Blake is co-founder of Forex Analytics. Blake spent most of his professional career as chief currency strategist for Wise Trade Group for 15 years, and then senior currency strategist for Ally Financial after the acquisition of Trade King, which owned Wise Trade Group. He is a co-owner of the Dallas-based brokerage firm and Liquid Trader Technologies, and has been trading markets for over 25 years. His company, Forex Analytics, aims to educate and build a community of successful traders around the globe. And next we have Stelios, which I definitely cannot pronounce your last name, Stelios.
Hello.
Stelios is the co-founder and chief macro analyst for Forex Analytics. He has an IT background, but he switched to trading and was a market maker for 10 years at Barclays and B of A in London. His trading decisions are driven mostly by fundamentals using technical analysis for entry and exit points. And last but not least, we have Brian Littlestone. Brian Littlestone is the founder of forexflowlive, which has merged with Forex Analytics. He has over 30 years experience, starting his career in dealing LME warrants and trading in the pits at Life as a local. He still trades his own account, and he is the host of the popular Flow Show in the European markets, prepping traders on the day ahead. So welcome, everyone. Welcome, everyone. Thank you so much for taking time out of your day to have this conversation with us.
Nice to be here.
So,
It's a pleasure.
I'll get started. So I'm going to ask questions. Please, if you have a comment or anything to add to anybody else's comment, please do. I mean, I like to make it kind of as much of a round table as possible. So with that, we'll just start. So I'll start with Blake. So this is just kind of a broad-based question for people that might not be very familiar with currency and currency crosses. Can you kind of give us kind of just that 30,000-foot view of the major ones, and particularly ones that we should be watching even if we're not currency traders?
Yeah, sure thing. Tracy, I just want to confirm, can you guys hear me okay?
Perfect.
Okay. Yeah. All right. Just making sure that my sound is okay. Thanks for having us here as a team. And the currency market, I feel, is where the heartbeat of all the markets are at. You know, it's interesting. I was listening to Samuel Rhines and an interview that happened with him like last week, and he's not somebody that really focuses on currencies too much. It's not his like forte, but he said something that's unique. But it's not unique to us, but it's unique to, I think, a lot of traders and a lot of investors, is the currency market's kind of the heartbeat of all the markets. I mean, it's the largest market in the world. It's where all the money's at, all the fiat currencies, right? And so as it's shifting between countries, between institutions, between, managers, it kind of will give us a clue to what's happening in the broader markets. So if you want to know what's happening and where the money's going, you follow currencies. You see what the dollar is doing. The dollar happens to be the reserve currency at this point, at least at this moment, and it still is, even though there's been a lot of de-dollarization. You've probably heard a lot of news about de-dollarization. But all in all, if you follow the currency market and you follow the money, as a lot of people like to say, it can help clue you in on what's happening around the globe. And so us as speculators, especially, Stelios, Ryan, myself, and, the people in the Forex analytics community, we kind of can, we not only trade the currency market, but it helps us identify how we want to trade other markets as well. So that's kind of like the bigger view of the currency market. How about you, Ryan? Stelios, is there anything you wanted to add regarding currencies and what we do?
Yeah, well, obviously we follow commodities a lot. Well, trading currencies, the obvious one is dollar CAD or CAD when you're watching oil. There's lots of people in our room who obviously trade both oil and trade the currencies as well. So there's always interlinks between currencies, commodities, and other markets. And there's something there for everybody. If you're a pure commodity trader, you can have a look and see whether currency is actually driving a commodity at one point and vice versa. So yeah, lots going on. We stick to FX in the main, but we don't stop there at all.
Hey guys, sorry about that.
She's back.
I got kicked off. I got kicked off, but I'm back.
Keep out your own show. That's awful.
We're gonna take over. Fine.
I know. Oh my God! I just got kicked off my own spaces.
And I just wanted to add one more thing, if I may. So FX pairs, the main driver is interest rate differentials. So yields, interest rates, and FX pairs are completely linked. So, you watch one market, you can kind of understand what's going to happen in other markets. So I just want to add that there is a lot of interconnection between markets, and FX is obviously one of the largest markets out there. So, yeah.
Next, let's take a kind of a bit of a deeper dive into the big ones that everybody is talking about, those being yen, yuan, and USD. So first, let's start with the yen, what it means, and why is everybody so laser focused on it?
Well, that's something that Ryan, I'm sure Ryan, Stelios, and I all have something to say about the did you ask about the yuan or the yen? I'm sorry.
Well, I want to talk about the yen and the yuan and USD, but let's start with the yen because, that's all you hear about is, all day long on Twitter is yen's about to hit 150. So what does this all mean and why is everybody so focused on the yen? And then we'll move to the yuan and USD.
Okay, so how about I start, Ryan, and then I'm sure you're going to have a lot to add here.
Yeah, go ahead, mate.
Yeah, so as far as the yen goes, the yen is, if you look at our central banks, you got the Fed, the ECB, the Bank of England, and all other central banks. Everybody's moved off the zero bound, if you will, and they've been raising rates, fighting inflation. Bank of Japan's, or the Japanese, Japan basically has been in a deflationary type of environment for 20 plus years, and they're finally starting to see inflation come through, and so the Bank of Japan has been very reluctant about coming off the zero bound. So what happens is when the Bank of Japan has rates at zero, and they still are at zero, but you have the Fed and other central banks raising rates 5% and higher. You get what's called the unintended consequence in the markets would be what we call a carry trade. So a lot of institutions will, I'll buy dollars, I'll sell yen to buy dollars, and then I'll capture the interest rate differential between the two. And that's a very common practice amongst institutions that want to park money in a bullish type of environment. And they'll continue to do so while there's that divergence between central banks. Well, so this has been the very first time over the course of the last, now a month, that we're seeing a new Bank of Japan governor, one who's willing to tweak, at least start tweaking their what they call yield curve control, which allows them to sustain low rates despite the upside pressure that they might be feeling in yields. It allows them to control a certain band to keep rates low. they know that rates eventually have to go higher, but the Bank of Japan also wants to make sure they're past this deflationary environment that they've been, I mean, generationally, they've been this way for 20 plus years. So as the Bank of Japan makes tweaks to their yield curve control, which is, something that just has happened with their new governor, Governor Ueda, this is like a very, 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 very small step in for them to normalize rates. Now, there's a lot of repercussions to that, and I'm going to let Ryan and Stelios talk about maybe some of the repercussions to the Bank of Japan adjusting rates. So, Ryan, what do you want to continue on from there?
Yeah, sure. I mean, what does the market like? The market likes a target. The market likes to think ahead, and we've been trading a lot this year as to whether the Bank of Japan are going to change to coming out their easing cycle and start tightening and raising rates. But while they don't do that, the market keeps hitting them. So you're going to see further yen weakness coming in. That's why everyone's talking about this big 150, because last time we were up there 152s. That's where they started intervening, coming in with intervention. So that's what the market's looking to play here. While there's no real change in policy, we expect dollar yen to keep scaling higher and putting the officials over there to the test. But then on the flip side, the move in the currency, because Japan is a heavy importer, particularly of oil, that's bringing in the inflation that they've been trying to get. So it's a sort of, they're trying to balance things over there in terms of not letting the wrong sort of inflation come in, keeping it under control, and getting the right sort of inflation in, which is something like wages, which they've had their highest wage packages coming through for decades, and that's set to continue. And as long as that does, then they're going to see inflation domestically coming in through wage hikes. That will then help the Bank of Japan be able to turn further to tightening, and then we may see the yen actually strengthening. But for now, I don't see any particular change until the Bank of Japan does, or they're forced to by the data coming in. But they've had some fiscal measures going on where they artificially reduced the price of fuel imports and things like that. So that will be washing out soon, and then we'll get that inflation print coming in. So again, something else to look at for oil if oil prices keep rising.
And maybe Stelios can talk a little bit about how institutions,
it's a funding currency.
Yeah, how institutions are positioned, especially when you take like local Japanese investors that are accustomed to buying other debt with yields starting to rise. How are they going to act moving forward?
Well, I think the main thing is the fact that because rates have been at zero, or actually slightly negative, right, for years, the yen has been a funding currency. So basically, investors or institutions will borrow in yen, which costs nothing, and they will buy another currency and do what's called a carry trade. So you borrow in yen, you buy dollars, you are making a carry, which is the difference between the two rates, which is what, 5%, 5 and a bit percent. So if you did that in 2023, dollar yen has gone up over 6% plus the carry. That's not a bad trade to do. So the yen has been a funding currency for a long time, and it's dangerous because then the market goes one way on this kind of carry trade, and when the Bank of Japan start normalizing rates, then this will be reversing, and we've seen reversals of carry trades and funding trades which can be absolutely brutal in the past, and so that's definitely a very, very important force that we need to be aware of.
Yeah, and if anybody ever wants to see like what happens when these carry trades unwind, all you have to do is go back to I guess 2006, just before the GFC, the Great Financial Crisis. You could see what an unwind of carry trades does. They get really popular amongst investors because investors will, like Stelios just mentioned, they can capture not only the carry, but they capture the depreciation of the yen as well. And that's been just common practice amongst investors, as of late. So just to kind of go back to the original questions, Tracy, why everybody's focused on the yen right now, it's because the Bank of Japan has started to tweak yield curve control ever so slightly. And people are worried that if they continue to move forward with normalizing rates to a certain extent, then it could eventually lead to yen strength, which then would lead to a liquidation of these carry trades, which then in turn could lead to a liquidation of other assets, other, risk on, quote unquote, risk on type of assets. So the yen is very much a focal point in not only the currency market, but that's why everybody's talking about it right now, because, as yields start to move higher in Japan, the risk might be that some locals, Japanese locals, which happen to be really large holders of debt globally, might sell some of their U.S. treasuries, which that's a lot of people attribute some of the reasons why the bond market's been selling off and yields have been going higher in the U.S. is because there has been selling of maybe some Japanese investors that are moving back into GGBs. Ryan, did I miss anything there?
No, you pretty much covered it, mate.
Okay, so so that's pretty much the overarching theme about the yen, and it is on, as Ryan pointed out, it's on everybody's radar right now as we are moving into the 145 to 152 level. There's a risk that the Bank of Japan or Ministry of Finance might start, quote unquote, checking rates. That means they're one step closer to maybe intervening. That'll freak the market out, get people buying yen. You might see, S&P futures come under pressure if something like that happened. So in a nutshell, that's why everybody's on edge right now.
Excellent. Very insightful and informative as usual. So let's move on to the yuan right now and some of the ways that, I don't want to say they manipulate the market, but
say it.
But
they do.
You just did. You just did.
But so, how in some ways is the yuan being weaponized? And, if we take a look at it right now, we're well over that 7 psychological threshold where China usually likes to rein it in. So are they purposely letting it go right now, or do you think they've lost control?
Ryan, do you want to start? You want to start there because you focus on this more than most of us. So.
Yeah, I trade this one quite a lot, and the reason I trade it is because of that manipulation, because they can be very clear what they're going to allow and what they're not going to allow. So if you're in a trade and they're, it's trending and they're happy to let it go, then you get good mileage out of it. But as soon as they turn around and say enough's enough, they're usually pretty clear. And in trading, you don't get often a clear signal to say stop trading that now or go the other way. So yeah, they do use it. They put the brakes on when we got into the sort of 728 area, 25-28 area. That put the brakes on it into June, into July for about a month. But now we've had all this data that's coming out really bad for China and these financial problems with the non-payments of investments and stuff. And that's putting the pressure back on a pair like dollar yuan. So we're seeing the yuan weakening again because the market's thinking they're going to be forced to ease, and they cut 3 different types of rates this week as well. But there's also the other side that they're not coming in as strongly to stop this move as they did back in June. So they're allowing it to go on. One of the reasons we're thinking behind that is that, it's going to help their exports. They're suffered on their trade data. So letting their currency weaken is going to help on that side. It also potentially gives foreign investors better currency exchange to invest into China. If you want to buy one, then you're getting a better rate day after day. So that's going to help with inflows into the country as well as those exports. So that's one reason why they might let it go. But on the flip side, they don't want to be seen as massive manipulators. They don't want to be seen too much as weaponizing their currency. So they're going to be mindful of that. But as you say, again, we can use a comparison to oil and oil producers. If oil producers want to put a top or a bottom in prices, then they cut or raise production, and that's no different to what we see in the one. So there's similarities there in how you can trade between what the bag holders, if you like, or the guardians can do with the market.
That's a great observation, Ryan, and it very much is. It's like they are OPEC in the currency market, or at least in the renminbi or the yuan. And when you're like, if you think about China and you think about the last several decades of China dominance as far as exports go, and then you look over the last, I don't know, you can say less than 10 years, as America tries to be more American centric and buy American versus buy Chinese, you see a lot of people, a lot of different countries, having things manufactured out of India or out of Mexico versus China. Their trade numbers are slowly deteriorating, and for them, they have spent the last several decades trying to build up a consumer-driven, consumer-driven economy, which, I think it takes more than just one generation of Chinese to really make a dent. They're still very big savers, so they're having a difficult time with reopening and being a consumer-driven economy. A lot of the Chinese. I'm speaking obviously in very general terms here, but a lot of Chinese will continue to save, and they're not going to spend money domestically, and that's what China was kind of hoping. So that lever, or you said weaponizing, Tracy, that's a way of China, basically controlling, how their exports are doing. If they can slowly let the air out of the renminbi or the yuan and let it continue to weaken. And you pointed it out, right? We're at levels we haven't seen. I mean, we're approaching levels that their most recent highs, back in 2022. But if we get above 750, I mean, I don't know where the top is, but that means that China is letting their currency continue to weaken, which makes exports more attractive, where people like America or England or somewhere in the Eurozone says, what, I can get those products from China cheaper instead of doing it in India or wherever else that you're doing it, and it's going to bring back business into China. And that's one of those levers that they'll pull if they feel that their economy is not sustaining, even after they've tried to explore different methods of stimulant. So
yeah. I'd like to quickly swing it back to you, Tracy, if I may, because obviously, again, taking a commodity slant, we're looking at oil. Global manufacturing, we know just by looking at the PMIs, is in a bit of a slump. China, obviously one of the big global growth engines, in a slump in manufacturing as well. We know that production cuts have been happening to help support prices, but why has oil risen so much when we know that pretty much 2/3 of the globe is in a manufacturing slump?
Were you asking me?
Yeah.
She's like,
you're the oil expert.
I was off getting an espresso. I don't know what you're talking about.
I was like, wait, I'm supposed to do the interview. Well, I think the oil markets are set to be really tight in H2, right? Because we've had OPEC cutting, and we had voluntary cuts, and then we have the extra voluntary cuts from Saudi Arabia. We're also probably going to start to see some decline in shale production heading into H2 as these rig counts that have come off for the last 6 months really start to filter into the market. And so I think unfortunately, even with this slowdown in PMIs, kind of this global slowdown in manufacturing that you have brought up, the market's still going to remain tight. So I think, it's kind of, we're still, I don't hesitate to say the word stagflation, but kind of creating a stagflationary environment where you have higher oil prices and lower demand.
Yeah, no, that sounds like that question. Thank you very much.
Absolutely. And then on to my next question. I want to kind of talk about, since I brought up stagflation, what should we be paying close attention to when it comes to stagflation, or what are the currencies we should be looking at, such as Euro, JPY, GB, Great British Pound, can't say GBP.
Just say the quid.
Hey, and Ryan, we should call it the pound or the sterling, right? Right?
Yeah, yeah. Well, Her Majesty's coin, whatever you want to call it. Yeah.
Well, so first of all, Tracy, I think that's a great question, and I think that I can say from even being in the markets and trading the markets since '96 is when I started trading. We haven't been in a stagflation environment, and not in my market's lifetime. And it's going to be really interesting to see how currencies respond. And I think probably the best example that we can look at right now would be what's happening with the pound or the sterling or the quid or whatever Ryan wants to call it. And Ryan lives in the UK. Ryan is like the living definition of stagflation at this moment. I'm joking, Ryan. But seriously, I mean, you got a situation where you have a Bank of England, a central bank that seems paralyzed at this point, not knowing if they want to fight inflation, which is obviously an issue. We saw some inflation data come in overnight, which came in a little hot. So, do you fight inflation, or do you fight slowing growth? And, the UK is probably going to be the poster child for the world, at least initially, as we go into a stagflationary environment. And frankly, I don't know how to trade the sterling, and I don't think anybody else does too. Because if you look at the pound, it's well off of 130, but it's also in breakout territory. So you don't know if it's going to be bullish or bearish at this point, and I don't know if I can definitively know how to trade it. What do you think, Brian?
Yeah, the pound's always a funny one to trade. You don't know what it's going to do at any one time, and I think the way to look at the stagflation trade is pretty much the same as we did on the inflation trade. Who's going to be the best of the bad bunch, or who's going to rise above it. And that's how I would approach this for trading any particular currency. We know the US is likely to be heading for this soft landing, if it's even a landing at all at the moment, given some of the data coming out. So the US still is out in front in terms of economic performance. Take a country like Germany, that's probably very much further down the table, looking very weak at the moment. The pound, the quid, the UK, looking sort of middle of the road. So that all influences. If you look at a country, you look at its currency, and you just have to match each one off against who's the strongest performer, who's the weakest performer, and that's how you sort of pick a trade in between those and what a currency is going to do over another one.
So let me ask you this, Ryan. Sorry, my mic was off or muted. Where do you lie as far as the Bank of England goes? I mean, what is the Bank of England going to do? I mean, I wouldn't want to be in their situation right now, and I definitely, if I was Andrew Bailey looking down at my balls right now, realize I don't really have any. What did I just say that out loud? I think I did. Sorry, didn't mean to say that out loud. Anyway, what do you think, which way do you think they're going to lean? That's what I want to ask.
I've been saying for a while, they've probably got one more hike in them, 25 pips, get the rate to 5.5%. At the maximum, they may have to go to 5.75. But they're at the mercy of what the economy does. Where.
Hold on 1 second. Stelios, can you mute yourself because you're creating an echo for everybody, just while you're not talking? Thank you. Sorry.
There we go. No worries. So they're where they should be on rates, and they've been behind the ball all the way through this. But as far as what happens after that, I think the UK is more at risk of two things: seeing sticky inflation, so inflation persisting for longer, thus keeping the BOE on the hawkish side. But also, we're at risk of having a steeper decline in the economy because of those higher rates than perhaps the US is and other countries. All that is going to create volatility for the pound. So if we can sail through this, yeah, then maybe I think the pound's going to be a strong gainer. But if we hit the skids and those rate hikes really start biting and hitting the economy, you're not going to be long the pound or wanting to be long the pound anytime soon. But I know Stelios has lived in the UK for a long enough time, so I'm sure he's got an opinion on this as well.
Yeah, for those who know me, I always like to take a few steps back and look at the big picture. And when I consider the pound, I think about what the Bank of England has to do. And the problem with the UK is that energy-wise, it's not as independent, let's say, as the US. So same with the Eurozone, right? It's a lot of energy dependence on oil and gas from Russia, etc. So we're seeing inflation in the UK being a lot stickier than, let's say, the US. That's obviously not a good thing when your economy is not really firing on all cylinders. And the problem that the UK has is that wage growth is also showing a bigger year-on-year increase than the US and then the Eurozone. So you're going to have second-round inflation effects in the UK. This is the main reason why I have been bullish the pound both against the dollar and the euro when we got breakouts or breakdowns on the two pairs. So basically, when the euro pound broke below 87.2, I said that's it. As long as we're below that, I'm bearish. And when the cable broke above the kind of low 124s back in April, if I'm not mistaken, I said, okay, I think I'm going to be bullish the cable. Mostly on the back of central bank divergence, because I think the Bank of England theoretically has to do more than the ECB and the Fed. Now, the problem we have is with this thesis, which always scares me because I used to market make sterling interest rates. The Bank of England, especially for the past 10 years or so, whenever they have the chance, they're going to be dovish. They always take, the error on the side of caution. So that's the problem when you bullish the pound. You're going to have the Bank of England governor coming out, and every time they speak, it's not good for the currency. So, but my view remains that inflation in the UK is going to be stickier than, let's say, the US, and that's why I like the pound versus the US. Now, the problem again, like Ryan said, is when you're hiking and when you're tightening more into an economy which is faltering, then eventually you're going to have to reverse and go the other way. So they're in a very sticky situation. What would I do in their place? I don't know. The mandate is to bring price stability and inflation to 2%. They have to write letters to the Chancellor of the Exchequer, if I'm not mistaken, why it's above 2%. Well, inflation is what? It's just below 7% now. So it's still very sticky. So it's a very difficult call. Contrary to that, the Fed is having a little bit of a better time because CPI is at 3% or 3.3 last reading, so it's a lot lower. Again, it's not a target, and I think the US will also eventually see second-round inflation effects because wages are rising, because oil has risen recently, and that has a lag, and it translates to goods and services. It has to. So it's a tricky situation for central banks. I definitely wouldn't want to be in the shoes. So I'll leave it at that.
And one of the things I want to make sure that all of your listeners, Tracy, that maybe don't follow the currency market as close as everybody as we do. One of the drivers, the main driver, actually I should just say this, the main driver of currencies is interest rates and interest rate expectations. So one of the things that we've seen in the currency market is we've seen the market stabilize after having this rip-roaring dollar move that we saw post-COVID, sell-off, as the stock market recovered, as everybody brought rates, back up. Everybody started raising rates following what the Fed was doing. The Fed was kind of first out the gate, starting raising rates aggressively. Now that everybody's gotten close to their terminal rate, the currency market gets very interesting from here, because what you're likely going to see moving forward is you're going to see like the Eurozone. You could clearly see it in Christine Lagarde's face. You could see it in her tan, and you could also hear it in her voice during the press conference last one. I know, Ryan, you specifically love to watch Christine Lagarde's tan. her shading every meeting. But what you'll see is she's a little bit paler, and she's a little bit more downbeat, and she's probably leading the Eurozone, to probably being one of the first, major central banks to maybe start thinking about, cutting rates at some point. Then you have the Bank of, the Bank of Japan, which the BOJ might be going in the opposite direction, where they start actually not only continuing to tweak yield curve control, but they might actually raise rates at some point, like they did back in, 2007, 2008 is when they did it the last time. Then you have the Bank of England, which we're kind of, as we just talked about, they're kind of, do you fight inflation? Do you fight a weakening economy? What do you do? Do you lower rates to help your economy, and then you're going to get a spike up second round of inflation, or do you fight inflation and at the mercy of the economy and pushing the UK economy into a recession? Then you have the US, which I think is up for debate whether we have second round inflationary pressures or not. And I tend to agree with Stelios here. I think inflation is going to be fairly sticky, and I think the Fed's not going to be quote unquote done. So the market's probably going to have to reprice, seeing rate cuts in the next year. And so as a result, you have these divergent central banks, which will spur volatility in the currency market. And everybody should understand that a 1 or 2% move in the currency market is a big deal. Not only is it a big deal for central banks because they have to navigate that, but for us as traders, it's great opportunities to see 1, 2, 3, 4% moves in currencies. It's like watching, based on the leverage that we trade in the currency market that a lot of us use. It's like watching, Apple or Amazon in its heyday. So there's a lot of volatility to come in the currency market, probably not only the end of 2023, but going into 2024, is interest rate expectations start to diverge amongst central banks now that everybody's at, or minus the Bank of Japan, everybody else is at a close to a terminal rate. You're going to start to see that divergence really move currencies again. And I think 2023, 2024 is going to be extremely explosive for moves in the currency market. And it's, in my opinion, it's going to be the place to be for years to come. We had many years of no volatility in the currency market because everybody had their rates basically at zero for how many years, guys? 3, 4?
I remember. 2017, 2018, you're lucky if you got a 20 pip move a day.
Yeah, and now, and for probably years, for the next several years, you're going to see explosive moves in currencies. And I know everybody's talking about the death of the dollar and, de-dollarization, and, we can go into conversations about this too. But the dollar is a fiat currency and it trades against other fiat currencies. So you're going to see a lot of volatility there. Plain and simple.
That was kind of the next thing that I wanted to ask you about, since you brought up the dollar. This is moving nicely. So I wanted to talk about, a little bit about, this is like a multi-part question, a little bit about yields and the USD relationship. And then I wanted kind of your views on strong dollar versus the stock market, because obviously, a strong dollar places pressure on commodities, particularly metals. It's not really a one-to-one correlation with the energy markets. But what about the overall stock markets? And after we saw kind of that break below 100, we see that bounce back, over 103. You think Yellen, with oil prices higher right now, or energy prices higher right now, do you think she's trying to export that inflation by letting the dollar move higher? I know that was a lot.
that is a lot. Hey, Stelios, do you want to kick us off with yields and how yields could really affect, and the bond markets can really affect equities and everything for that matter?
Yeah, sure. So there is when the dollar rallies, that can be an issue for well, the world economy, because first of all, because of emerging markets, countries that cannot borrow in their own currency, they borrow in dollars. So when the dollar becomes more expensive, there's a lot of pressure there, and that's definitely a risk. There's also over the past 15 years or so, so after the global financial crisis in 2008, when we got to zero rates and governments, central banks started doing QE, buying everything, what happened? We had a huge boom in equities because of basically rates being at zero. So it was almost costs nothing to borrow and to take risk. So what did people do? And companies, they issued debt, they borrowed, and they bought stocks and other assets. I mean, a perfect example is Apple, sitting on, what was it, 300 billion of cash or something like that. And then they went ahead and issued more bonds because they can, because they can borrow at 1% or whatever it was. So you have this 15-year trend going all the time, and buybacks, companies issuing bonds, buying back their stocks, and you had equity markets basically going a lot higher on the back of cheap money and of zero rates. Now, when this is reversing, and it is reversing, obviously, the more yields go up, the more equities come under pressure. I don't think we've seen the full effect of rates going up, because let's face it, we've seen interest rates and yields go up so fast, so much so fast. We haven't seen this in 20 years, and yet equities are still relatively resilient. The S&P is still 350 points from its all-time highs. So I think the more yields stay high and the more the monetary policy stays tight, the more pressure there's going to be on equities. And we are actually now at on the 10-year US at a major point at 420-ish, which was a previous high. If this breaks to the upside, then we could be heading towards 5%, and that is definitely not going to be good for equities, not in the short term anyway.
Yeah, Ryan, do you feel that yields are going to continue to rally here? I mean, the bond market looks very vulnerable, and how's that going to affect what we do in the currency market?
Yeah, I think this could continue for a little bit longer because everyone is trading the central banks are higher for longer, the Fed keeping rates higher for longer. And it is a yield play for an investment point of view. As you said, rates at zero, Stelios as well, rates at zero for nearly a decade or over a decade, close to zero. Investors had nowhere else to put their money to earn it. They had to go chasing risk. Now there's more choice because you can go and park your money in a 2-year, 5-year US bond and earn a decent, 5% return on it. You don't need to chase risk anymore. For certain investors, and that's what it's all about at the moment. So we go through cycles. The old risk on, risk off changed as we came through the GFC. Then we had the COVID and everything that happened there, and it's changed again. And now we're seeing the risk on, risk off change back to more old risk on, risk off. So risk off is now seeing commodities falling, commodity currencies falling, that sort of thing. But it's
and you have choices now, right? Like,
yes.
If the let's just say the poop hits the fan, markets come under pressure, everybody realizes, oh my gosh, we're going to a recession, and let's just just for argument's sake, let's say I'm correct, and we the S&Ps are back below 4,000 by the end of the year. Will the dollar respond well? I think it will. I think it usually when the tide goes out, you see how many people don't have their swim trunks on. So that always happens, right? When everybody's talking about de-dollarization, when everybody needs the dollar, when poop hits the fan, everybody goes running back to the dollar. But now they have an opportunity to lock in, higher rates and a quote unquote, riskless investment, right? You could buy bonds that are yielding, so-and-so percent, whether you're talking the shorter end of the curve or, longer end of the curve globally. So I think with yields going up, there's more opportunities now, right, for investors.
Yeah, most definitely. And, particularly if we're seeing a top in interest rates, actual interest rates from central banks, there's a need to lock in those rates, because if rates are only going to go down from here, you're not going to get these returns again. Potentially, if rates drop down to neutral levels, 2.5%, 3%, as most central banks want them, you're not going to see these levels again. So investors are going to take money out of risk, take it out of stocks, because now stocks are not relying on cheap money to keep inflated. They're relying on company performance to keep them inflated. And if we're going to see economic problems, stock prices are going to fall. So it's all about locking in yield, locking in your returns at the best opportunities. And this, at the moment, there's not been this opportunity to lock in those sort of yields, 5% for sitting on your arse for many years.
Right. And I mean, if you're an investor and you're looking at your year to date, returns, and let's just say, the S&P is up, what, 15, 16% from the beginning of the year, whether you're at those returns, maybe slightly higher, whatever it is, you might be looking into 2020, the end of 2023, thinking, yeah, I think I do feel a recession's coming. I'm going to go ahead and lock in my returns here in equities. I'm going to go ahead and push my money into dollars because I feel maybe I'm a little naked right now. I need to pick up some dollars. I'm also going to deploy some of that capital into, bonds globally for, you name it, you name whatever, maturity you're looking at, whatever yield you're looking at, whatever country you're looking at. But you can see how yields are now attractive to investors that want to capture, as Ryan, as you pointed out, it's capturing yield, especially if we're, what I feel is in a longer term range environment in equities, longer term meaning several years of consolidation. So,
yeah, very much, very much.
And then I don't know what your feelings are on the third part of that whole question that I asked about Yellen letting the dollar go higher to export inflation being energy prices are higher.
What do you think about that, Ryan? Stelios?
It could be just my whacked out theory.
Yeah, it's always a tough one.
No.
with the US, because they're the only country that has a let's call it a manipulators list of ticking off other countries that are up to no good with their currency. So they have to be careful what they do on their own doorstep.
We're not on that list that we made.
No, you're not. You're not on your own list. Funnily enough.
Nope.
Talk about China manipulating their data, and you guys are just as bad, it seems. But yeah.
Hey, now just because
the thing with the US is the US is such a big economy. The dollar is everywhere. It's hard to go down that route of weaponizing it. Obviously they don't want too much divergence on the currency. You don't want it too strong, too weak. But there's a huge range that you can play in with that before it becomes a real problem for them.
And then I kind of wanted to move over to some like EM currencies, particularly Mexican peso, because Blake, I've heard you kind of talk about the peso and its relation to the U.S. market. So could you explain that a little bit?
Sure. I'd love to. Actually, you and I were on a podcast together a couple of weeks ago, and we were talking about the Mexican peso as it dropped below 17, and the dollar Mexican peso, that is. And we talked about the strength of the peso because, or the weakness, if you will, that we're seeing now, but the strength at the time, because the Mexican peso it is a currency that is the carry trade darling of the FX market. There's other countries out there that have higher rates, but the Mexican peso is one of the more liquid ones, where people will sell dollars, they'll sell euros, they'll sell yen, and they'll buy Mexican pesos in a carry type of trade environment. Very similar to what we were talking about with the yen, where investors will sell yen and buy sterling or buy Aussie dollars or US dollars. They do the same thing. Maybe you could say more aggressively with a less liquid type of country like Mexico. Well, Mexico's got a lot going for it. It's our neighbor of the United States, and it's also become more of you've seen a lot of people move their business, their import business from China to Mexico. So Mexico is naturally going to be a beneficiary, and I think they will be for years ahead, for the years ahead. I do believe the US dollar Mexican peso will be moving lower over time, probably closer to a 14, 15 handle. We're currently trading at 17. In other words, I believe the Mexican peso is going to continue to strengthen over time. And this has been my take for the last couple of years. However, we've gone pretty far. We've, dropped quite a bit over the last year and a half on a big carry trade environment. And you have you can read any bank research from, Citi to JP Morgan to Goldman, and, everybody talks about the carry trade basket, the emerging market carry trade basket. Well, in an environment where you start to see stocks come down, one of the first places you're going to see that air let out of is the emerging market currencies like the Mexican peso. And then on top of that, you have other LATAM currencies, namely like Chile, which not one size shoe fits all, but a lot of LATAM currencies tend to move together, and their central banks tend to move together somewhat. They're all starting to embark on a rate cutting campaign, and so a lot of people have been speculating that maybe the Banxico might be finished there as well. So you combine a little bit of softness in equities, a little bit of speculation that the Banxico might be cutting their rates, maybe even before the U.S. That could spur a big movement, a reversal, if you will, in the U.S. dollar Mexican peso that's been trending lower, literally nonstop. I want to say since COVID, the COVID lockdown, but really since December of 2021, we've seen the currency pair drop from like the 22 handle to the 17 handle, which is a big move for a currency. I mean, you've seen the Mexican peso rise over 20% against the dollar. So you might see a little bit of that unwind in the months ahead, where the dollar Mexican peso gets back towards 18, towards 19. Its 200-day moving average is somewhere up there above 18. And I think that is a risk for not only the Mexican peso, but other LATAM currencies. But that's another signal that we as an investor, especially if you're an investor in the equity markets and you're looking around going, holy cow, I'm seeing this currency trade, a very common currency trade called a carry trade in the currency market being unwound. If that happens, that should be another indication that stocks probably are more or closer to the top than at lows, right? And so the dollar Mexican peso is very much in my front burner, something that I'm watching very carefully as I'm cooking around in currencies, and I think a lot of the currency market is too. And I think if you trade equities and you're an investor in the equity markets, if you start to see the Mexican peso weaken, that is a pretty strong indication that people are getting cold feet at current levels in equities. Ryan or Stelios, did you guys want to comment a little bit about emerging market currencies here?
I don't really trade them, so I don't have much to say. I mean, your point about the peso being one of the currencies that's going to be moving quite a lot if we see a risk-off move, that's definitely right. And it's not just the peso; it's other commodity currencies are going to suffer as well, like Aussie, Kiwi, the kroner, but. I don't actually trade the peso, so I don't, or other emerging markets, so I don't have really much to add. Maybe Ryan does.
And Ryan, before you say something, I just want to jump in. If you guys really want to see a massive move in currencies, go take a look at the Mexican peso. When we went into COVID lockdown, globally, and you'll see that the dollar rallied against the peso 36% in like a couple months. It was bananas. I mean, we've unwound that completely and then some, but those are the banana type of moves that you see in risk-off type of environments. Sorry, Ryan, I didn't mean to step on your toes there. I just wanted to make mention of that because it was so massive. Go ahead.
Yeah, no worries, mate. Good point. Well made as always. I want to be cheeky and ask you another question, Tracy, to do with Mexico. What's happened to the Hacienda hedge these days? Are they spread it out now so it doesn't have much of an impact? This is something that was I think it was February time, used to be a big thing in oil markets and currencies as well.
No, their hedge is still huge. I mean, that's really the only way they're actually making money, being that Chemex is having a lot of troubles, and now just put that nicely. So really, that's the only way that they're actually making money.
Yeah, but do they spread it out there? Because was it just in February they used to announce it and then start doing it, but now
It
they sort
used
of
to be a
spread it
bigger
over the
deal.
year?
Yeah, it used to be a bigger deal. They wouldn't tell you when they did it. They just told you after it was done. And they're still pretty secretive about it.
Yeah, yeah.
So you don't
Okay.
know. But
Yeah,
our friend,
no.
our friend Robert from Marathon Resource Advisors, um, has a question for you guys.
Yeah. Hey guys, thanks a bunch for coming on. Can everyone hear me okay?
Absolutely.
Yeah.
Great. So I was even before you started to go towards what are the good risk off pairs, that's what I was going to ask you.
Okay. And that was it to your question, risk off pairs. And I think it's a great question. And the scary thing is you see a lot of them already moving
Because implied vol is very cheap, or positioning is really offsides.
Wait, you cut out there. You cut out there, Robert.
Oh.
All we heard was risk off pairs, and then you cut out.
Oh, yeah.
Okay. Is it better now?
Yes.
Okay. So implied vols are cheap.
Oh, you could.
Or positioning is offsides.
You're cutting out.
Oh.
You're cutting out again.
Sorry. I'll send you the question by DM.
Okay.
Well, I think we could answer that question pretty well. Just kind of understanding what his the basis of and the reasoning is. Because implied volatility is cheap right now. So, what are some risk off currencies that you can kind of trade? I'll start and I'll say the dollar, well, the yen or any yen pair is kind of a wild card because you don't know what the BOJ is going to do in the Ministry of Finance. They could be one of those that. I would naturally, under normal circumstances, say, oh, you could short the Aussie yen or the New Zealand yen. I think any commodity currency against the yen, even the Canadian yen, would be a good trade. The wild card is, how about if the BOJ or the Ministry of Finance does not intervene and they just let the yen continue to weaken here, and Ueda becomes paralyzed and doesn't want to do anything more on yield curve control the rest of 2023. Maybe that trade won't work. I think one of the best trades is long dollar MEX, but it's hard to carry that for a very long period of time because of the carry costs, especially if you're an institutional type of trader. So then you have to look at breakout points, and like in this case would be 1745. I think if we clear 1745, 1750 in the dollar MEX, we'll probably be trading well above 18 in very short order. Like when I say that, I'm talking within a couple of days. So you don't have to have the carry interest working against you near term as an institution. You can just try to capture it really quick, but you have to be quick on your toes. And then I also think that euro or sterling crosses like the euro Aussie, euro New Zealand would be good trades for a risk off type of environment. But a lot of them have been moving quite aggressively already. Ryan, is there anything that you want to mention there?
Yeah, I mean, if you're looking at currencies right now, I think the dollar is it. We're seeing dollar strength pretty much everywhere. We just mentioned it with dollar MEX. It may not be shooting higher, but it's stopped going down, and that's a big deal when it's done nothing but go down for months on end. The same thing with the commodity currencies, Aussie, Kiwi against the dollar. They're all moving lower, so the dollar's in the ascendancy at the moment. And that's happening whether we get good news or bad news in markets. So right now, I think that the dollar's where it's at. From there on out, I think you've got to look at close pairings to the dollar, like the Canadian dollar, for example. We're seeing dollar CAD rising at the moment, but it won't take much to flip that trade back towards the CAD. Particularly if we get risk on and oil's moving higher, then you get a switch there. But yeah, for me, it's the almighty dollar, as you guys like to call it, Blake.
Yeah. I mean, look. You know, one of the scary things, and we talk a lot about this during the day to our traders, is you look at the Aussie dollar, which is a really, really weak currency, and it shouldn't be. Not when you know, taking S&P. That's, you know, how many percentage points are we off of our all-time highs? Not too far, right? But you take the Aussie dollar based on the weak China opening that we've seen, the weakness that we've seen in copper that's sitting right on support right now. You know, the Aussie dollar could very easily be trading below 60 cents, which is a 400 pip move from here if you short the Aussie US dollar, and the Aussie dollar can't even get out of its own way. So those, you know, as Ryan just pointed out, dollar against the Aussie is always naturally a good selection in a risk-off environment. Stelios, is there anything else that you wanted to mention regarding that?
I just want to say, if you want to see which currency is going to perform on a risk-off move, just go to March 2020 and see what happened there. So Blake mentioned the peso, which was the biggest mover. Then you have currencies like Norway and Aussie, Kiwi, Canada. Things like that. That's what I would look at. And I agree with what Blake says. The peso going against that has bad carry, so I would probably pick one of the others. But yeah.
Yeah, I was going to say you're fond of the knock on that basis. Would you trade it as a risk pair or risk currency?
Weirdly enough, I would. I love the knock, but if I think things are going down the toilet, I would definitely trade it the other way for a short-term trade. Yes.
Excellent. Well, I know you guys are kind of on a time crunch, so I wanted to do just the last round of questions. It's the same question for all three of you. Really, it's the final question. You can talk about anything that we haven't discussed yet, or another currency that you wanted to bring up that we were not able to discuss yet, and or what should we as traders, investors be particularly watching over the next few weeks, few months?
Who wants to go first?
Yeah, I can have a crack at that one if you want me to go first. Right, so if you're dipping into FX, there's two things you've got to look at first and foremost. Volatility. Do you want a lot of volatility or do you want little volatility? If you want little volatility, you want to look at a pair, something like Euro Sterling or Aussie Kiwi, one of the close crosses, as we call them, because they tend to be lower volatility. They take a good amount of time to move anywhere decent. It means you're not getting spiked out in big volatile moves. Then you've got the majors. Everyone's talking about dollar yen. So you know what the word on the street is. You know what levels you need to look at if you want to trade that. That gives you a bit more volatility. And if you want to jump on the bucking Broncos, then you look at your dollar mixes and pairs like that. But yeah, it's for investors where you want to put your money any way you like. You just got to know your risk. If you're going to be trading anything at all, know your risk, know your market. Have an idea what the economy is doing, what the big market movers behind that currency or country are doing, and it sets you up for some potentially good trades.
Stelios, you want to jump in, or you want me to go?
I can go. Well, what am I looking at? I'm looking at yields like a hawk because I think that's what's driving pretty much everything. And so with the 10-year US on the verge of breaking out now. Okay, could be a false breakout, but I'm looking to see what yields are doing, and I think that's going to drive pretty much all markets, FX, metals, you name it, and I am still, people who follow me will know I'm always looking to get into precious metals longs at good levels. The way I trade them is very particular. I don't use leverage, and I have much higher time frames. And I'm looking at silver in particular, and I am already a little bit long, and I want to add more. But yields are going to be driving everything, so we need to watch those like a hawk because we are at make or break level now.
Awesome. And, I'm going to leave you with this because we haven't talked about the euro too much and really the dollar as a whole. I just want to say for the record, I'm actually more of a dollar bear longer term. I'm not a dollar bull. I do believe that countries are systematically moving away from the dollar and the dollar's dominance is I think it's the time is coming where we're going to see a shift away from the dollar and more to a different type of currencies. And I don't know what it looks like. I don't have that type of foresight. But what I do feel is like the euro, even though it's trading at 109 right now, I think dips below 105 longer term are going to be opportunities to be buying, euro. I think the euro could be eventually trading back up at 115, 120. I don't think the dollar index. I think the highs that we saw post COVID, if you will. I think those highs are in our rearview mirror, and I think that I'll be selling rallies longer term. That doesn't mean right now, like at this moment in time, I am a dollar bull. I think that the dollar has further to go against most currencies. But whether you're talking about the euro, the Aussie dollar as it dips below 60 cents might be a great opportunity. I think commodities are going to be hot for the next several years. So selling the dollar on rallies, or in other words, buying the euro on dips, buying the Aussie on dips, maybe over the next few months is where my play is going to be as we go into the end of this year. So that's kind of where I stand.
And with that, thank you, gentlemen. That's all good stuff that you left us with today to think about. And I want to thank you very much for your time today. I know you guys are really busy. Thank you to our audience for tuning in. We really appreciate you. Please follow these guys on Twitter. They all post a lot of good information. Forex Analytics has a lot of education for new currency traders. So urge you to go look them up. The links are in, I think, each of their Twitter bios. So definitely go check that out. Follow Place Your Trades to see what else we have going on over there. And with that, I will see you guys next Wednesday. And thank you again for your time, you guys.
Tracy, it's been our pleasure. Thank you. Thanks for
Thank you very much.